changes in group structure, step disposal from control to control. Now, in this episode, we're going to look at the disposal of a parent holding in a subsidiary, but still maintains control. So it sells off a portion of its shares, but still holds more than 50% of the shares of the other entity, which is different from the other two episodes that we looked at, where control was lost. So if a parent who owns 80% of the equity of a subsidiary disposes of 20% out of it, the parent does not lose control as it still owns 60% of the shares of the subsidiary. Then there wouldn't be the need to calculate profit or loss on disposal. So what will happen is that because there is a sale, there will be the inflow of cash. So cash or bank will increase. So we have to debit it with the sales proceeds. Then we'll come and credit non-controlling interest with a portion of the addition of the net asset and the goodwill of the subsidiary. We'll look at a test of understanding so to be clearer. There will be a difference which is supposed to be either debited or credited to retained earnings. So let's test our understanding to make things clearer. So Bernice owned 80% of the equity shares of Pascal. She sold 20% of the shares on 31st December 2019 for $70 million. The net asset at the date of disposal was $200 million, and the goodwill on acquisition of the original holding was $50 million. So we are to assume that the goodwill is full goodwill. We are to effect the necessary entry to record a change in ownership. So for the solution, we will debit bank with the proceeds, which was $70 million. Then we'll credit non-controlling interest with $50 million. We got that by multiplying the new holding of the subsidiary, which is 20% now, by the net asset of the subsidiary plus goodwill. So 200 plus 50 million. Because the bank is more than the value of the non-controlling interest, there will be a positive figure. That will mean we'll have to credit it to retained earnings for the $20 million. A credit to retained earnings is a positive push. Let's finally test our understanding. So Felix sold 10% of the 100% equity shares it held in Maxim Limited on 31st July 2021 for $30 million. Goodwill on acquisition on the original holding was $65 million. Net asset at the disposal date was $335 million. We are to assume that the goodwill is full goodwill. So we are to make the right entry to record Felix's change in ownership. So for solution, we'll start with debiting bank with the $30 million sales proceeds. The non-controlling interest will be $40 million, which is the new holding of the non-controlling interest, which is 10% on the value of the net asset, $335 million, plus $65 million, which is the value of the goodwill. Okay, so now you see that the non-controlling interest value is more than that of the proceeds, which is a deficit. So we'll now have to come and reduce retained earnings. We do that by debiting the retained earnings with the $10 million, which is the difference.